Hello and welcome to the third video in the How to Trade series. Now, what are we looking at? Well, this is a chart of the S&P 500 and I'm going to do a very nice trick on this market for you. And this is something, if you trade the S&P 500 or any US index, this is a must know. So we're going to go into that right now. So as a trader, you have to get used to creating a trade plan for yourself. And I've got one in my head, but you might like to write this down on a piece of paper. So it goes like this. The first thing I do is I put the period separators on the chart. And this is MT4 and it's very easy for me to do that. So with the period separators on the chart, what I look for now is I look for the Asian session low and the Asian session high. Let's mark those up. So what I've done is put a line on the Asian session low, and as we've traded slightly higher in the European session, I can actually put my line on the high of the European session. Now the thing is, if you put this on the top of the Asian session, the line would have been about on that candle there, about 8 bars in. Now usually what will happen in the American session is the American traders will usually exceed the Asian session high and usually exceed the Asian session low, so the range will expand. The other thing I'm going to do, very important, is I'm going to put on the high and low of yesterday. And the reason I do that is because I like to orientate myself. Where am I? Am I at the top or am I at the bottom of yesterday's candle? So let's do. So with that done, we have a very clear idea of where is high in this market and where is low. We also know, because if you look at the S&P or look at the Dow or look at the Russell, they often trade in a very similar way, and that way is that the American traders love to be on the extremity of the market. So if this market was going to fall, this would be a good place for it to fall from because it's at the extremity. It's close to the Asian session European high. Now there's nothing to say that they won't blip this high here. So at the moment, if we look at the trend on this market, what you can see is that the market was going up, and on Friday it looked like it traded sideways a little bit. You can see that was the open, we made a high and then we pulled back. So for me, the trend is not down. If we break Friday's low, then it's just like the 4-hour chart. What you're looking for then is you're looking for your first push down, your retrace to the upside, and then when it breaks that low there, you know that you potentially have a change in trend. Well, at the moment we don't have a change in trend until that low is broken. So if this market's still going up, then you wouldn't expect it to exceed this level. So this, for me, would straight away be, because I don't know it's going to turn, this will straight away be a buying level down here. And similarly, I don't know that that isn't the top, so I don't want to be buying up at this level here because that's possibly a level. If that top was in, let's say, we don't know yet, but if it was, we wouldn't expect the market to go much above there. So I already have a plan for the day. The probability is that the market is going up. The chances are that if they break this low, we could be going down, in which case I'll just catch the next retrace back up and sell the market. But at the moment, the market's still going up, and I'm pretty sure that the Americans will come back and retest that Asian low there. We know where the low of yesterday is, so this would be a good buying area, and we just have to wait and be patient and see what happens on the American Open. We developed an indicator which basically measures liquidity. Now, if you study a chart and you spend a lot of time looking at candlesticks, you can see that there are all sorts of patterns that are candlesticks related. This is an engulfing bar. So an engulfing bar is high liquidity. Here we have a doji followed by an upside down hammer. That's again liquidity. Up here we've got, I think they call that an abandoned baby. It's a big push up and then a little candle. And here we've got a powerful engulfing candle right at the top. And basically what the liquidity indicator does is it actually looks at these structures and it gives it a liquidity value. So you don't have to sit there and spend 10,000 hours looking at a chart just so that you can read the liquidity. And also this does it automatically. It never gets tired, never makes a mistake. It keeps on giving you the liquidity. So when I take a trade, I want to see that there's a lot of liquidity associated with this level. And you can see we're right down here at the moment. But for us to get a turn that I'd feel comfortable about trading, I'd like to see the liquidity actually start to print in this sort of level. Because once I see it print in that level, I know that I have a high probability of catching a liquidity turn. So yes, you can. If we just blip that top, and let's have a very close look in at this market so we can see actually what's going on. If I was to mark, if that was the top level there, I'd mark that level, and I'd probably mark this level here. And so this area would be a level that I would be looking for the liquidity histogram to push up. Now, if you read candlesticks, you'll start to see doji formations, engulfing bars, whatever it is, abandoned babies, dragonfly dojis, whatever these candlesticks are telling you, and you need a good eye. I can't do that, and I've been looking at charts for more than 10,000 hours, and it's difficult. So this is why I like the liquidity indicator. Do you need it? The answer is no. You can do it yourself, but it will take quite a lot of time to train your eye to actually see these structures on the chart. But liquidity is a fantastic tool to actually help you spot changes in trend. So we're going to just wait until the liquidity starts to come up into that area, because it's going to let me know where my level is for trading. And then I'm going to put on another indicator. And don't think that we just put indicators on for fun. These indicators are actually extremely sophisticated at measuring liquidity, and liquidity is always associated with a turn. So we'll let that print, and then we'll come back and do the analysis in a little. So it's coming into the US Open, and as you can see, the US market has actually pushed up. The S&P has actually pushed up, and we've taken out the Asian session high. Now, often what it does is it will bounce around within the range of the Asian session high and the Asian session low. And what you know is when the Americans come on board, they're going to take out the Asian session high, and then they're going to go back and they're going to take out the Asian session low, just as they did on Friday. They took out the low session, they took out the high session, and basically what they're doing is they're collecting liquidity. Now, as we move along with this market here, you can see that we've just pushed up, pushed up, pushed up. So when the US market opens, what's actually occurring for them? Well, it will have closed somewhere there on Friday night, down there, let's say. And so for the American traders, the futures traders, they're going to see a massive gap on their chart like that. Now this is called an Amat gap. Amat gaps occur at the end of trends, and basically it's people who think to themselves, oh, this market's going up, I'm going to ride it forever. Usually these gaps appear, and when they appear at the end of a strong move, when it gaps up after the end of a strong move, or it gaps down at the end of a strong move down, that's the end. That's telling you get out, because all the people that had the fear of missing out in that market basically just get hammered. And it's something that I always look for. And also an Amat gap, which is the one that occurs at the end of a trend, will often not just be filled, but it will be sliced through massively. So at the end of a trend, never think you're just going to get a gap fill and then you're going to get a resumption of the trend. That's an amateur move, so never do that. So we've just come into Friday's high, and as I said, that's going to be a massive gap for the American traders when they open up their charts on the US Open. Of course, it's a CFD contract, not a futures contract, so you get this trading continuously, so you don't see a gap, but the futures traders will. So the play today is to look at the liquidity building. You can see that we're coming up into this level of liquidity that I said we might be wanting to watch. So let's have a look at the 15-minute chart, because we might see something quite interesting. And as you can see, that on Friday we got the formation of aqua candles, and when you get aqua candles, this is telling you that there's a lot of liquidity in there. Now on Friday, when they brought it up to this level, you got the formation of yellow candles, orange candles. That's not so high in terms of liquidity, and look what they did. They pushed it down a little bit, and then they went back, they hammered that top just to catch the liquidity up there, and then they hammered it down, and you got the formation of an aqua candle, high liquidity, excuse me, and then they turned it around and pushed it all the way back up again. So really simple trade today, because we're at Friday's high, we've gapped up, we can be pretty sure that they're going to want to fill this gap. If they don't fill it today, they'll definitely fill it tomorrow, that's for sure. So I'm waiting for the liquidity to actually print an aqua candle. Probably won't do that until the US Open. You can see our liquidity level there is actually coming down a little bit, and that's a good sign, because it means that liquidity is actually drying up. So that big push to the upside is perhaps the end of this particular move. But as I said, I'm looking for an aqua candle and then a dark blue candle, or two aqua bars, just to pip Friday's high. I think that could be a very good trade. So we've got to sit on our hands, do something else, because what we don't want to do is second guess the market. We want to trade when it's actually telling us I am going to turn, and then we can get in. So just have to be patient and wait for the. So here we are, a couple of minutes into the US session, about 8 minutes, and you can see that what we've got, we did actually take out Friday's high, and we got liquidity form there. We got a little doji candle. Now I'm not in, and the reason I'm not in is because I was looking for an aqua candle. Now it could be I miss it, so that's just the way it is. Or alternatively, because we've broken that little swing there, I would look for a retrace back up, and I would look to sell the retrace. The fact is that we've taken out Friday's high, we've taken out the liquidity. I know very often that the American traders will want to go down and hit the Asian session, so they oscillate through the Asian session high, although the Asian session high was the American high today. So I would love to join that market down, but I know if I start selling a market that's moved like that, chances are that it's going to retrace back up, and I just watch my trade go underwater and think, why did I not wait? So fortunately, I can't really get into that trade when it hammers down like that. So I'm just going to have to sit out on this one, and if it goes and it touches the Asian session low, so be it. But if I go down onto a 5-minute chart, we might be able to see aqua candles, which unfortunately we did, but I was looking at the 15-minute, so that's my bad. And what I would have done for entry on this, if I had looked at the 5-minute, I wish I had, is I look for an aqua candle. I'll just mark this. I look for an aqua candle followed by a dark blue candle. So here we had an aqua candle, but the next candle was aqua, so that's the last aqua candle in the series. There's your dark blue candle, and the entry method is to just put your entry on the top of the dark blue candle. So if I'd been looking at the 5-minute chart, that's exactly where I should have entered, and I should have put my stop just above there, which would have been a 15-pip stop. And yeah, that's 130 points down, so that's kind of going to come into a 10-to-1 trade. Sometimes that happens, and sometimes when I make videos I think, oh, I wish I'd taken that trade, I wish I'd gone on a 5-minute. So my advice to you is look at a 5-minute chart, a 15-minute chart and an hourly chart if you want to do intraday scalping. But there's nothing to say that this market won't come back up to here. And in fact, you can even see that we would have a liquidity void on the 5-minute. So the liquidity void will go from here to the bottom of that candle there. So that's your liquidity void, just like that. It's a big void. I don't like big voids. I prefer small voids. The other area I would be looking at would be this one here, because if that was a head and shoulders pattern, you can see the head and shoulders we got. This is a shoulder, this is a little neck, and then we go back up and we form the head like that. So in effect, yeah, head and shoulder pattern, maybe, which means we could come all the way back there. Well, a failed session is as good as a successful session because you actually sometimes learn more from the failed session. As it was, I didn't manage to get a trade in. If I'd been looking at the 5-minute like I should have done, not making the video, then you would have seen that we could have nailed that top to perfection. So just got to be patient, wait on your hands, wait for this market to retrace back up, and then we can try again. Excellent. That was a well-planned day. Unfortunately, the plan didn't go as intended. The market did sell off. We did get the aqua candles forming on the 5-minute chart. I did manage to get in. I was looking at the 15-minute chart, but the market did pretty much what I expected it to do. It came back down and it took out the low of the Asian session range. And this is a move that the S&P, I'd imagine that the Dow and the Russell like to do. And it's something that you can be reasonably sure that if you are looking at the Asian session high, Asian session low, then you look at the US boys to actually break the high and then go back down and take out the low. And basically it's a liquidity strike. What they're doing is traders are told and they believe that they should put their entry on the top of the Asian session. So when the market breaks out, they will go long. And of course, as the market's going in an uptrend, everyone would expect that to work. And they're told to put their stops below the low of the Asian session. So they can virtually guarantee themselves to be stopped out, because this is a very common move for the S&P to make. And you should really go back, look at your past chart, and just mark the Asian session high, Asian session low, and see how often they do actually try to go back and take these highs and lows out. And also, if they don't get them on the exact day, very often they come back for them the next day. Well, if you like this video, please like and subscribe. That motivates me to make the next one. And in the next one, I'm going to cover something quite interesting about these markets and how you trade them. Well, thanks very much. And if you want, you can join our Discord group. It's completely free, and the link is in the description below. Well, thanks a lot for watching, and see you next time.